The appreciation strategy is a portfolio aimed at beating the market over a market cycle, but doing it with materially less risk than the S&P 500, which is our benchmark. So we do that by owning high-quality stocks, big cap stocks, so companies with great business models, often monopolies or oligopolies, so high market shares, excellent balance sheets, strong management teams.
At the end of the day, what we're trying to do for our clients is to gain as much of the upside as possible, protect them in downside or more difficult markets. It's a combination of capturing that upside and protecting in the downside that's made appreciation a successful strategy over time. We look for companies that earn, to start out with, higher returns on invested capital. And we look for companies that can either maintain those returns for a longer period of time than the market believes, or that we believe those returns will improve over time. So when you do that, you get a certain subset of companies.
So there are about 200, maybe 300 stocks that we could potentially own in the strategy, given our goal of owning really high quality companies. So we kind of have this bench list of companies that we like, and what we do is look for opportunities to go and buy them.
Buying those stocks correctly, so when the opportunity or the risk reward on those stocks favors us, typically we like to see a 3-to-1 upside to downside reward on those stocks, and holding them for longer periods of time. The appreciation has a very low turnover compared to its peers, and we think we gain an advantage by owning companies and letting them work for us over time. And then the final step is to make sure, from a valuation perspective, we're doing a very thorough sensitivity analysis.
The key thing about the appreciation strategy is that in bad markets, it's defensive. What investors typically do when the market goes down an awful lot is they get nervous and they sell. And that's exactly the wrong thing to do. When the market is really bad is when we shine. And late in the business cycle, when the market starts to worry about risk, is when we really shine.
In those big up years, and you get them occasionally, a couple of times in a decade you get these big up years, we'll tend to lag or not do as well in those type of years. Why? Because we have a lower risk profile. We're a more conservative fund. But in those big down years, and unfortunately you get a couple of those every decade, we tend to do a very good job preserving capital. And so we'll tend to capture or be down a lot less than the overall market. And it's the combination of performance in the up years and performance in the down years that gets us to our belief that we can provide returns competitive or better than the benchmark with lower levels of risk over time. And I think that consistency of performance and that consistency of returns is very unique to the appreciation strategy.